Okay, so this is the review session for midterm 2 for EGME 401 for fall 2022. Okay, so midterm 2, there's quite a bit of content to go over, at least in terms of problems. And so I thought what I do for this review session is I just cover the three, I'd say, main categories of problems, that we went over, at least, the three most time-consuming ones. And so I'm going to try to go through all three of these in about an hour. And then, and I'll try to just do a quick review and then maybe an example problem for each. And then, hopefully that'll be good. Okay, so let's start with rate of return. All right. So historically, rate of return, where it gets its name is that it's traditionally used for investments. And so, if you invest a certain amount of money and you get some money back, and then you want to know, what's the rate of return on your investment. That's basically what it means. But for our calculations, what it basically boils down to is, we want to solve for the interest rate. Okay. Okay. Right. Because in most of the problems up to this point, I've given you the interest rate, or the interest rate's been given to you in the problem. But for these ones, you're going to solve for it. Okay? And the way you solve for it is a little bit, it's quite different than what you normally do for most problems, because there's no, with the exception of, I think, the simplest rate of return problems, there's no straight formula that's going to give you the interest rate. Because if you look at a lot of our our cash conversion formulas, we're talking about the formulas here, not the tables. The interest rate is usually buried within some kind of exponent, right? Okay. And so even for a very simple case, let's look at a case where we use a P over A conversion. Okay. And so P over A, and so let's say that we set up a present worth present worth equation. And so we end up with a formula that looks like the following. And so we have 1 plus I raised to the n minus 1 divided by I, 1 plus I raised to the n. Okay. And so if you just have something like this, and we've done enough problems at this point to know that P over A is something that we almost always use, or it's used very often in our analyses. And so if we have something here where the n, even for an n that's somewhat modest, and so let's say we do it for like 4 or 5 years, right? That's still, this is going to be a pain in the butt to solve for, because the I here is kind of buried within this very high ordered polynomial term. And so usually the way that we solve for the rate of return, granted if in case that you didn't have in case you didn't have like a computer software available to you, is through interpolation. Okay. And what we're interpolating between is interpolating between different values on the compound interest table. Okay. And so basically, the way it works is like this. And so first, it's kind of a two-step process. So first, you're going to set up some kind of cash equivalent equation. Okay, and what I mean by that is you're going to combine all the cash flows in the problem into a single equation, and usually that means converting it all to a single form. And so usually, what we do is a present worth, but you can also do like an annual cash flow equation as well. Okay. Step two is that we're going to um, once we set this up, we're basically going to plug in different values for the interest rate. Okay. And the idea is that we basically want to solve for the interest rate that's gonna turn our step one into zero. Okay. Okay. Likely, this is not going to be an interest rate that comes straight from the table, and so this is going to be somewhere in between. And so what we're going to do is we're going to keep repeating step two until we see that the present worth or whatever equation we set up in part one changes signs from positive to negative. Okay. Okay. It can either go from positive to negative or negative to positive. But basically, the idea for step two is that, we're trying it at sequential interest rates. And so, we do two, and then we do interest rate of 3%, and 4%, 5%. Okay. So what I saw a lot in the homeworks is that, people were kind of interpolating between two very far places. And so they might try interest rate of 1 and then interest rate of 20, and then interpolate between those, right? And so, the idea behind this process is that you choose two interest rates that are pretty close to each other. And so the interpolation doesn't work that well if you choose interest rates that are very far apart. Okay, so that's kind of one thing to keep in mind. And so kind of once you find the point, or once you find the point that it does change signs, then step four, what you're going to do is you're going to interpolate between them. Okay. And then once you find the interpolation, or once you evaluate that interpolation, then that's going to be what the rate of return is. Okay. And so that's how you do kind of your basic rate of return problems. So remember, it's an iterative process. And so, most of the time you're not going to find it on the first guess or your first two guesses. And so you're going to have to keep guessing and checking. And then once you find that point where they change sign, then you interpolate between those. Okay. For cases where you are performing comparison, and so this is kind of where I saw a lot of people trip up in the homework. Whenever you're doing a comparison, you want to set up kind of an additional step. Okay. Okay. And of course, what I mean by comparison is that you're comparing two economic alternatives, and you want to determine, which one you should go for. So very similar to what we did in the first half of the class with present worth analysis and annual cash flow analysis. And so when you want to do rate of return to do a comparison, you have to do what's called incremental rate of return. And what that means that we're going to, instead of taking the rate of return individually for each option, what we're going to do is we're going to take the difference between those two. Okay. And so for this one, the important thing is that you're not supposed to take the rate of return of each individual option. Okay. Okay. I mean, you can. I mean, it's not illegal or anything, but it's just gonna be kind of a waste of time. And so what you need to do is that you need to take a difference. And so you're going to take all the cash flows from each of those two options and subtract them from each other. Okay. And you're going to do the more expensive option minus the less expensive option. And by more expensive, usually what I mean by that is the option with the higher initial cost. Okay. 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 And so you're going to do this for all the cash flows. And so you're going to set up this kind of difference equation for not only the initial cost, but also for the revenue. You're set up for the maintenance costs, any kind of overhaul costs that you're going to have to do too. Okay. And so you want to basically you almost kind of form a new option, a third option, which is the difference between these two. Okay. Okay. All right. So let's do an example. And so I'm going to do an example from the previous homework, actually. Just because I think this is a good one to do. Okay. And so this is going to be problem 2B from homework 4. Okay. And because of time, I'm only going to set it up and then kind of show you the steps that I took to get there. But you can look at the homework solutions for the full one. Okay. And so in this problem, we kind of take the role of a restaurant, and we're considering moving locations. Okay. And so there's two locations that we want to look at. Okay. And so there's either a Westwood location or there's a Santa Ana location. Okay. And so to set up these problems, it's usually a good idea to make a table like this. Okay. And so each option is going to have their initial cost. Each option is going to have their rent. Each option is going to have the revenue. And in the problem, what they describe is that there's going to be an increase in the revenue as well. Okay. All right. So the Westwood location is going to have a higher initial cost because it's going to cost more to move there. And so from the problem, what the problem says is that the initial cost for moving to Westwood is $95,000, and the initial cost moving to Santa Ana is $65,000. Okay. For the rents, we're not given in the problem exactly what the rents are going to be, but it does tell us, how much more it is going to be. And so what we're told is that the rent in Westwood is going to be $1,500 more expensive than Santa Ana. Okay. And since we're taking the difference, we don't need to know exactly what the rent is. We just need to know what the difference between them is. And so, for Westwood, we know, what we can say, just, just kind of imagination is that we're paying a rent of 1,500, and then for Santa Ana we're paying a rent of 0. It's not exactly that, of course. There's no landlord in the world that will let you rent space for $0. But remember, what we're taking here is the difference. So it doesn't really matter what the rent actually is, as long as we can create the difference, which is all we really care about. Okay. Okay, so this Westwood location is going to have a revenue of $20,000 in the first year. For Santa Ana, is going to have a revenue of $17,250 in the first year. Okay. And the revenue is expected to increase by $2,500 each year after that. Okay. All right, and so we're going to take the difference. And so, because the Westwood location has a higher initial cost, that's going to be our, higher cost option. And so the difference is going to be 30,000 for the initial cost. For the rent, it's going to be a minus 1,500. For the difference in revenue, is going to be 2,750 in the first year, and then the yearly increase is going to be $500. Okay. Okay. And so now that we've created the difference, we want to find the present worth of this difference. Okay. All right, and so we're going to convert all these cash flows to present worth. And so first we have the initial cost, which is a minus 30,000. And since that's the initial cost, that's already going to be in present form. And so we don't need to convert that any longer. Okay, so we're going to leave that as minus 30,000. Next, we have the difference in rent. And so the difference in rent is $1,500 each year, or I guess we're doing this per month. Okay. And to convert this to present worth, we're going to have P over A, I 12. Okay. Then what we have is the difference in revenue. And so the difference in revenue is a positive 2,750. And so this is going to be P over A, I 12. Okay. And then we have the increased. And so, I'm not writing out the full problem statement here, but if you read the problem, this should be a bit more clear. And so what the problem is saying is that each month, the revenue is expected to increase by that flat amount each month. And so if we take the difference between them, that's $500. And we know any increases like that are characterized as a gradient. So that's going to be P over G, I, since we don't know the interest rate, and 12. And I think in the problem it tells you that it's for 12 months too. Okay. Okay, so we've set up our present worth equation here. And so what we can do from here is that, of course, we can't evaluate this unless we assign a interest rate, because we don't know what all of these conversion factors are. Okay. All right, so what you're going to do from this point in the problem is you're going to plug in different values for the interest rate, and then plug it into this expression, and then you're going to get different values of the present worth. Okay. And just like I mentioned before, as you plug in different interest rates, the present worth is going to change value. And what you want to look for is, the point at which the present worth is going to change sign. Okay. And for this problem, it's going to change sign from positive to negative. And so when you go from, let's say, 6% to 7%, it's going to change sign from positive 648 to negative 1396. And so that the rate of return is going to be somewhere in between there. Okay, and so you're going to interpolate between 6 and 7%, and that's going to give you the answer to this problem. Okay. All right. And so that was kind of a quick review of rate of return. I didn't want to spend too much time with it because I think a decent amount of people kind of have the hang of it. And so let's go ahead and move on to the next topic, which is taxes and depreciation. All right, so we spent a good amount of time on taxes and depreciation in this class. Just because there's kind of a lot to cover, so I'm gonna try my best to kind of cover everything that I can. But basically, the idea behind this unit is, we're learning how taxes affect our calculations in our cash flow analyses. Okay. And the upside to this is that, essentially, because of our government, we have to pay a certain percentage of any revenue or a certain percentage of any money that we make to the government in the form of taxes. And so for most of this unit, what we assumed was that it was 21%. Okay. Okay. And so whatever revenue that we have, the government says, I'm going to take 21% of that, and that's going to be used to pay for, for State Fullerton, it's going to be used to pay for, police. It's paid for our politicians, stuff like that. Okay. But, there's kind of a caveat. And so, just to kind of encourage businesses to kind of conduct their business in America, there are ways to reduce the amount of taxes that you pay based on the money that you spend to run your company. Okay. Not we, I should say companies. Okay. All right. And so what this basically is called, or the way that we call this, usually is called deductions or expenses. Okay. Okay. And so the idea behind this is that instead of getting taxed on the entirety of the money that we make and the entirety of our revenue, we're only going to get taxed on, a certain amount of that. And what we can do is that, what the government basically says, that any money that you spend to actually run your business, to operate your business, whether that be money that you pay out in labor to pay your employees, money that you pay for materials, or more complicated, the money that you pay for large capital expenditures, you can deduct that from your taxes. Okay? And so, we have this idea of what we call taxable income. Okay? And so this is different from your kind of your raw revenue, your raw income, and this is the amount of money that you are going to get taxed on. Okay, and so the way we compute that is we take your gross income being just the raw amount of money that you made from sales. Okay, you're going to subtract your ordinary or necessary expenditures, and so these are things like labor, material, equipment costs. Okay. Okay. And then you're also going to subtract the depreciation charges. Okay. Right. And depreciation, as you probably know, this is the amount of value that you're going to lose from your large equipments or large assets each year. Okay. And that's kind of what we spend the bulk of our time computing in this unit. And so the reason, remember the reason we kind of differentiate between the two, and so, the reason depreciation is kind of kept separate from ordinary necessary expenditures is that the idea is that whenever you buy a large piece of equipment, it doesn't lose its entire value immediately. Okay. And that's not necessarily true for like say like raw materials. And so, let's say that you buy cement to run your construction company, right? And so you're gonna buy the cement and then you're gonna use it up immediately into whatever building that you make. Okay, so you don't keep the cement; it gets kind of used up. And so that's why when you go do your taxes, you can kind of deduct the entire cost of the cement immediately because you don't actually keep it past that 1 year. Okay. Same thing for labor costs. And so when you pay your employees, that money is, the company doesn't retain any value from paying the employees. Hopefully the company pays their employees enough, unlike House like Fullerton, so that they retain them for long periods of time. But once that money passes from the company to the employees are then, that's their money. Okay. For large assets, it's different. And so when you purchase a large asset, let's say like a car or a truck, the car or truck, is still owned by the company after 1 year, and it still retains value. And so, you can keep using that truck year after year after year, and then you can actually sell it at any time and kind of recoup some of some of those charges. Okay. So that's why we keep depreciation different because it's it kind of follows different rules and it kind of retains more value from there on. Okay. All right, and so from the class, we learned that there's several different ways to compute depreciation. I'm not going to test you on all of those on the exam, and so I'm going to focus mostly on just two main types of depreciation. Okay. There's straight line depreciation, and then there's bonus depreciation. Okay. All right, so these are the two main types of depreciation that you're going to be responsible for the exam. And so I know there's a few questions on the homework for MACRS, but MACRS requires it's a little bit too time consuming for a paper exam. And so these are the ones I'm going to focus on. All right. And so the idea behind these two depreciation schemes that for straight line depreciation, you're going to depreciate kind of a flat amount each year. Okay. Okay. And so I think this is I call this one the most intuitive form of depreciation because I think just naturally humans like to think in a linear sense. And so when when you're saying that your asset is losing value each year, it makes sense to lose kind of a fixed amount. Okay. Okay. And so the way that you compute the straight line depreciation is you're going to take B minus S, where B here is the initial cost, or what's more, I guess what's more accurate is the book value. Okay. Because when we combine this with straight line when we combine this with bonus depreciation, it may not be the initial cost of the asset. Okay. S here is the salvage value. And we're going to divide this difference by N, where N is the number of time periods. Okay. right? And so we basically take, the difference between, what we're starting at versus, what the salvage value is, and just dividing it by the number of periods. Very simple. Bonus depreciation is a kind of a just like a flat amount of depreciation that occurs at the beginning of the time period. Okay. Okay. And by time period, what I mean is the entire timeline. And so beginning of time period is basically just in year one. So let me go ahead and rewrite that. Okay. And the way we compute this is that we just take a certain percentage of the initial cost, and then that's going to be depreciated in year one. Okay. Okay. All right. And so here's the kicker. And so, the kind of where these things get a little bit complicated is that, when you combine these depreciation schemes. And so what we'll see often is that we're going to combine um, both straight line and bonus depreciation. Okay. And so when you combine these two depreciation schemes, okay, when you're combining depreciation schemes, what you need to do is you need to make sure that when you add up all the depreciation, it doesn't exceed your initial cost. Okay, and so there's kind of a two-step process. So first, what you're going to do is you're going to compute the bonus depreciation. Okay, right, and so that's the first thing you're going to do. Next thing you're going to do is, you're going to compute whatever's left after the bonus. Whatever's left after the bonus depreciation, you're going to apply the straight line depreciation to that. Okay. Okay. So that's just kind of a very, very quick example. So let's say that we have something with an initial cost of $100,000. Okay. And let's say that we are going to apply a bonus depreciation of 20%. And the rest is going to be made up with straight line depreciation, assuming a salvage value of 0 and over 8 periods. Okay. All right, and so to compute this depreciation schedule, first we're going to take 20% of 100,000. And so this is 20,000. Okay. And so immediately, kind of right off the bat, we're going to depreciate that $20,000 of value from this asset. Okay. Okay. And so if we depreciate $20,000 of value off the asset, then the amount that we have left is 100,000 minus 20,000, which is equal to 80,000. Okay. All right. And so when we compute our straight line value, it's going to be based on this 80,000, not on the 100,000, because we've already depreciated 20,000, and so what's left after that is the 80,000. Okay, so we're going to do 80,000 divided by 8. Okay, because we have a salvage value of 0, so the S value is 0 here. Okay, and so what we get from that is $10,000, and so that's going to be our straight line value. Okay, and so if we were to write out the entire depreciation schedule, okay, and so this is going to be for 8 years, and so in year 1 we have 20,000 plus the 10,000. Okay, remember to apply the straight line value there as well. And so year 1 we're going to have 30,000, and then each year after that is going to be 10,000. Okay. And so that's how you combine the two. And so if you want to check your work with depreciation, you can add up all the entries in your depreciation column, and this should equal the initial cost, assuming your salvage value is 0. So if your salvage value is 0, then this should all kind of add up to what your initial cost is. Okay. Okay. So let's do kind of a bigger example here. Okay. And so this is also going to be from homework 4. So let me go find a good one here. Let me find one. Well, I guess we don't have one that has both straight line and bonus, huh? That's a little bit annoying. Let's see, check homework 5. Okay. Let me do this. And so let me modify one of the homework problems. And so this will be problem 4B on the on homework 4. Okay. So I'm not going to do the whole problem because that would take a bit too long, and I do want to talk about replacement analysis. What I'm going to do is I'm going to modify it, and I'm only just going to do the first row of the table for design 1. Okay. Okay. And so for this problem, what we have is an initial cost. Our initial cost is $350,000. And our revenue is constant each year. And so revenue is $95,000. Okay. And so what we have N is equal to 7, and so it's going to take place over 7 years. Tax rate is 21%, and our interest rate here is 4%. Okay, and so based on this, we are tasked with computing the after-tax present worth. Okay, and we are going to apply some depreciation rules to this, and so let me do this. And so let's say that this asset is subjected to let's say we have 20% bonus depreciation. And the rest of the depreciation is made up with straight line with a salvage value of 0. Okay. Okay, so let's compute the depreciation schedule first. So first we have the 20% bonus depreciation. Okay. And so what we're going to do is we're going to take 20% of the initial cost. So the initial cost here is $350,000. And so we take 20% of that. We get $70,000. Okay. And so that we're going to depreciate kind of immediately in year 1. Okay. And the straight line value is going to be based on whatever's left. Okay. And so if we take $350,000 and we subtract 70,000, what we're left with is $280,000. Okay. And then we're going to divide that by the straight line time period, which is 7. Okay. And so we take 280,000 divided by 4, divided by 7. Okay. And what we get is a straight line value of $40,000 each year. Okay. All right. So now that we have the depreciation values, we're going to go set up our tax table. Okay. So let me go ahead and set that up. And so we have one column for the year, one column for the before tax cash flow. Okay, so that's going to be either our initial cost or the revenue. We have another column for the depreciation. Okay. We have another column for the taxable income. We have another column for the taxes, and then another column for the after-tax cash flow. Okay. All right, so I'm not going to fill in this whole table because it's going to take too long, especially because I'm computing this from scratch. Okay, but I will do the first couple rows just so you can kind of see how it goes, and then you can kind of repeat it from there. Okay. Okay, so first let's put all our before tax cash flows, and so we know that we have an initial cost of $350,000, and so we're going to put that in as minus $350,000. Okay. In year 0, we don't have to pay any taxes because we just bought the thing. Okay. And so our after-tax cash flow is going to be just the same as the before tax, which is minus $350,000. Okay. All right. And so in addition to this, we have revenue of $95,000 each year. So actually, we can go ahead and fill that in all the way through. Okay. Right, and so that's going to go all the way down to year 7. Okay. All right, next we have depreciation. And so depreciation, remember, in year 1 is going to be the sum of the bonus depreciation and the straight line value. So it's going to be 70,000 plus 40,000. And so year 1 is going to be 110,000. And then every year after that is going to be 40,000. Okay. All right, taxable income. And so taxable income is the difference between your before tax cash flow and the depreciation. Okay. And so we're going to take basically column 2 and subtract column 3. And so in year 1, we have 95,000 minus 110,000. And so that's, of course, going to be a negative number. Okay. And so our taxable income for that year is actually minus 15,000. And if you know, if you remember, whenever we have a negative cash flow, what that basically means is that we're going to get a tax credit. Okay. And so we're actually going to get some money from the government. Okay. For every other year, the difference is going to be positive. So it's going to be 95,000 minus 40,000, which is 55,000. Okay. All right, so taxes. And so to compute taxes, we're going to take our taxable income and multiply it by 0.21, which is the tax rate. Okay. And so first we're going to do it for year one, which is a minus 15,000. So let me go ahead and pull up MATLAB. And so we have 15,000 times 0.21. And so that's going to be a minus 3150. Okay. And for every other year, we're going to pay taxes in the amount of 11,550. Okay. Well, I said I was going to do the whole thing, but I guess because it's, pretty nice, we can go ahead and do the whole thing. Okay. All right, and so from here, to compute the after-tax cash flow, you're going to take the before-tax cash flow and subtract the taxes, okay? And so for year one, we have 95,000. We're going to subtract a negative 3150. So this is going to be a positive 98,150. Okay. Every other year, we're gonna pay tax, and so we're going to take 95,000 minus 11,550, and so that's going to be 83,450. All right. And so from here, you're almost done. And so the only thing you have left to do here is to compute the present worth. Well, in this problem, they asked for an after-tax present worth. And so you're going to take the after-tax column and you're going to compute the present worth of that. Okay. Sometimes it requires you to to do kind of individual P over F conversions if the cash flow table is not that nice. And so don't be afraid to do that. And then you can go from there. Okay, so I won't do that part because that part really will be very time consuming. And I do want to leave some time to talk about economic life and replacement analysis. And so let's go ahead and move on to the next topic. Okay. All right, so we don't have a lot of time left, but I do want to go over this and what this means. Okay, and then maybe I'll try to squeeze in an example, but we'll see. Okay. Okay, so this is one of the last things that we covered in the economics portion of the course. And so with economic life and replacement, what the question that we're trying to answer is that, is it better to replace an existing asset or is it better to kind of keep the current one that we have? And so kind of the situation that we have is that, we are working for a company, we have an asset that we're using in our operations. Okay. It's starting to cost a lot of money to maintain this asset. So either the maintenance costs are going up or maybe it's breaking down and we have to fix it a lot. And so we're asking the question, is it better to, keep it or is it better to replace them? Okay. All right. And so to do this, we're going to compare two things. And so first we're going to compare for the existing asset, we're going to compute what's called the marginal cost of ownership. Okay. Okay. And what this is basically what is the cost? What's the cost going to be to keep this asset for one more year? Okay. Okay. And so that can be things like in maintenance costs, or maybe it's, you expect it to break down at some point during the year, and so you have to fix it. Okay. And so you have to ask your question. You're only going to ask the question for just one extra year. And so for one extra year, how much is it going to cost to kind of maintain this asset? Okay. And then you can assume that you get rid of it after that year. Okay. What you're going to compare it to is for a new asset. Okay. You're going to compare it to basically the yearly cost of ownership for that new asset, over a certain period of time. Okay. Right. In other words, we're computing the equivalent uniform annual cost of owning a new asset for a certain amount of time. Okay? And so to compute this, what you're going to need to do is an economic life analysis. Okay. And that's the main thing that I wanted to review in this one, because that's the one we kind of spend the most time on. Okay? And so you're going to compare these two values, and you're going to see which one is lower. And depending on which one is lower, that's the one that you're going to go with. Okay? And so basically, if it's going to be cheaper to keep your existing asset for one more year, then you should keep the existing asset for one more year. If it's going to be more expensive to maintain an asset versus buying a new one, then you should buy the new one. Okay. All right. So let's review how to do economic life analysis. Okay, so in economic life analysis, what you're going to do is, you want to find out, two things. And so first of all, we're going to find out what's the optimal amount of time that you can keep an asset and keep it, that you can keep the cost down. Okay. And two, if you do keep the asset for that amount of time, how much would you pay per year to own that asset? Okay. Right, and ideally, you're going to keep this as low as possible. And the idea is that, for different amounts of time, and so let's say you keep an asset for 4 years versus 5 years, then the yearly cost of ownership is going to be different. Okay. And so let's just take a very simple case where you purchase an asset, but you don't pay any money to maintain it. Okay. Um, and so in that case, you're just paying the initial cost. Okay? And so if you only keep that asset for 1 year, then you basically pay the entire initial cost just to use it for that 1 year. But if you use the asset for at least 2 years or 3 years, that initial cost kind of gets spread out among those 3 years. Okay? And so, you can kind of almost think of it as like, you're dividing the initial cost by the amount of years that you use it, although it's not quite that because we have to take the interest rates into account as well. Okay. Okay. But kind of in a more realistic case, what's actually happening is that, you also have maintenance costs. And so it's going to cost you yearly to kind of maintain your asset. Okay. And so, because maintenance costs are rising every year, you can't just keep a machine, you can't just keep an asset for a very long period of time. Okay. Okay, and so the way to do economic life analysis is you're gonna examine an asset, you're gonna examine a new asset, and you're gonna take all of its cash flows. Okay. Okay. All the cash flows for a new asset, and you're gonna convert it, you're gonna convert each of them to a uniform series. Okay. Once you convert it to a uniform series, or first of all, you're going to set up the equation for it. And so you're not actually going to compute it yet because we're going to evaluate this equivalent uniform annual cost for different values of n. Okay. Okay. All right. And so you're going to evaluate at different values of n, and then you're going to do that until you find the minimum. Okay. Okay. And then that value of n is going to be your economic life. And then the corresponding value of EUAC, that's going to be the yearly cost of ownership. Okay. All right. And so, I only have just about 5 more minutes. And so let me just kind of let me run through an example we did in class really quick, just because it's pretty simple. Okay. All right. And so let's say that we're purchasing a new machine. And let's say that the new machine has an initial cost of $7,500. Okay. All right. And so this machine can last 10 years, but we may not want to use it for all 10 years. Okay. All right. The maintenance costs. The maintenance cost for this machine is going to be $1,200 in the first year. Okay. But each year that you use the machine is going to be an additional $900 each year after that. Okay. All right. All right. And so using this information and an interest rate of 8%, okay, using this information, we want to compute, what's the economic life and what's the yearly cost of ownership of owning this machine. Okay. All right. And so we have 3 cash flows in this problem. So we have the initial cost, we have the uniform maintenance cost, and we have the amount that's going to increase. Okay. And so let's convert all of them to a uniform series, and let's put them all into a single equation. Okay. All right. So first we have the initial cost of $7,500. Okay. So initial cost, remember, is always a present sum. And so we're going to convert that to a uniform series. And so we have A divided by P. Okay. The interest rate here is 8%. And the unknown here is the value of n. Okay. Then we have the yearly maintenance cost, the flat amount. And so that is a $1,200. And so that's already in uniform series format. So we don't have to convert that. Okay. And then we have the $900, which is the increase. Okay. And so an increase, member, is always represented as a gradient. And so we're going to have A over G, 8%, and N. Okay. Okay. So now that we have this equation here, and we can't evaluate it yet because it's we need to plug in for the value of n. Okay. And we're gonna evaluate this at different values of n. Okay. All right, so let's go ahead and start with this down. Okay. All right, so I'm not going to evaluate each individual column because we're a little bit short on time, and I'm only going to go up to year 6. Okay. Okay. All right, and so basically, to get the values in this column, I'm basically plugging in different values of n into the equation above. Okay, so if we plug in n is equal to 1, okay, and so that's going to change the values of this conversion factor and this conversion factor. Okay. Then what we get from that is an EUAC of 9,300. Okay. We plug in n is equal to 2, we get 5,838. We get n is equal to 3, we get 4,964. Plug in n is equal to 4, we get 4,728. N is equal to 5, we get 4,739. N is equal to 6, we get 4,870. Okay. All right. And so what we're going to do here is we're going to look and see which one is the smallest one. Okay. And so the smallest one, the smallest EUAC here corresponds to n is equal to 4. Okay. And so this tells us that the economic life here is 4 years. Okay. And if we keep the asset for 4 years, then we're basically paying $4,728 each year to use it over those 4 years. Okay. Okay. And so that's how you interpret the results. Okay. All right. And so if this were, and so we only did 1/2 of the analysis here. So we only did it for the economic life. But if this were part of a whole kind of replacement analysis, what we would do is we would compare this value to basically the marginal cost of keeping the existing machine for 1 more year. And so if the marginal cost for the current machine, if that was greater than this, then it would be better to replace it because the equivalent uniform annual cost of a new machine is less than the yearly cost of the existing one. Okay. All right, and so that is it for the review. Okay, so I do have something else to do right now, and so I'm gonna go ahead and close this here. And so I know I'm a little bit late in posting this, and so it's gonna go up probably Tuesday afternoon, so right before the Tuesday lecture. But hopefully you'll find this useful as you're studying for your exam. Okay, and so if you have any other questions on anything, please let me know. You can come to office hours. I have 2 more office hours until for the exam, so feel free to come to those. Or you can send me an email and I can answer your questions on email. Okay, so best of luck studying, and I will see you all on Thursday.